This video presentation offers thorough insights into FIRPTA for foreign real estate investors. FIRPTA, which stands for the Foreign Investment in Real Property Tax Act, was enacted in 1980 with the aim of regulating the taxation of real estate sales involving foreign investors. The law requires buyers to withhold a portion of the sale price and submit it to the IRS to cover any taxes owed by the foreign seller. FIRPTA applies to different types of real estate, like land, buildings, mines, and natural resources, and aims to ensure foreign investors pay taxes on their gains from U.S. property investments. Under FIRPTA, foreign sellers of U.S. property generally have 15% of the sale price withheld by the buyer for taxes. It's essential for both parties to consult tax professionals well-versed in FIRPTA regulations to ensure compliance and accurate withholding, as exceptions and special rules may apply. How does one get the 15% withholding back? And when foreign sellers subject to FIRPTA, withholding may be able to obtain a refund of the withheld amount under certain circumstances. File U.S. tax return. The foreign seller needs to submit Form 1040-NR, U.S. non-resident alien income tax return, for the year of property sale. This form tallies the profit or loss and determines the tax owed to the IRS. Claim withholding credit. The foreign seller can offset their tax liability by claiming a credit for the FIRPTA withholding amount paid to the IRS by the buyer during the sale. Refund process. If the withheld amount surpasses the seller's tax owed, they might qualify for a refund. The IRS typically issues refunds after confirming compliance with all requirements. Timing. Refund timing varies due to factors like tax return processing and IRS review. Typically, refunds arrive within a few months of filing, though delays are possible. To qualify for an exemption from FIRPTA withholding, foreign sellers must meet certain criteria. Here are some common ways to qualify for an exemption. If the sales price of the property is below a certain threshold, typically $300,000, the transaction may be exempt from FIRPTA withholding. The seller must have owned and used the property as their primary residence for at least 2 out of the past 5 years. Some countries have tax treaties with the United States that provide exemptions or reduced withholding rates for certain types of real estate transactions. Certain transactions, such as like-kind exchanges, 1031 exchanges, may qualify for non-recognition treatment under FIRPTA, deferring tax liability on the gain instead of immediate withholding. Foreign sellers can seek an IRS withholding certificate to cut or remove withholding obligations by demonstrating their projected tax liability and submitting relevant documents to the IRS. To get an IRS withholding certificate, foreign sellers should fill out Form A288B and submit it, along with necessary documents, to the IRS. This form is available on the IRS website or through tax professionals who focus on international transactions and FIRPTA compliance. The application should detail the seller's information, property details, expected tax liability, and any pertinent information. Sellers may also need to include supporting documents like appraisals, contracts, and financial records. After submission, the IRS will review the application and issue a withholding certificate stating the required amount, if any. This certificate can lessen or remove the withholding obligation during the sale, aiding foreign sellers in avoiding excess payments and simplifying the transaction. To avoid paying taxes under FIRPTA, foreign sellers can take several steps. Foreign sellers can apply for an IRS withholding certificate to reduce or eliminate the withholding obligation based on their expected tax liability, potentially reducing the sale's withholding amount. In addition, strategically structuring the sale, foreign sellers may cut FIRPTA withholding by involving domestic entities like corporations or partnerships for property holding and transfer. Lastly, given FIRPTA's complexity, foreign sellers should consult tax professionals such as specialized accountants or tax attorneys for guidance on international transactions and U.S. tax law. Understanding FIRPTA is crucial for real estate deals with foreign parties in the U.S. It affects outcomes and compliance. If you have any questions regarding FIRPTA, it is advisable to seek guidance from a tax professional. They can provide comprehensive information and assistance tailored to your specific needs.